as I said, so this next presentation I'm very excited about. Brian Korn, he's a partner at Manatt. They're doing some really exciting things in what we call this Reg A securitization space, and taking a lot of these, utilizing Reg A, expanding it beyond the traditional equity markets and equity deals, and taking that to fixed income. So we're going to see, how it's going to be used to create this new breed of fixed income retail alternatives. Thanks, Brian.
Thanks, Dara. This is a great conference. Very happy to be here and be involved. I have hard copies of these if you're interested on this chair right here and also on the table in the back. I'm just going to take a couple of minutes to walk through a little bit about the basics of Reg A, where it fits into the capital structure in terms of raising capital, and how structures are being set up to enable non-accredited investors, retail investors, access to marketplace products, marketplace lending products, without going through full-blown SEC registration. So the Jobs Act, as Steve just pointed out, April 5th, 2012, President Obama signs into law. We have former Majority Leader Eric Cantor behind him and some others looking on. What was the Jobs Act? The stated purpose was to increase American job creation and economic growth while improving access to public capital markets for emerging growth companies. Really, the focus of the Jobs Act was the IPO on-ramp and the ability to start an IPO at a lower cost, go through the registration process confidentially, show less in the way of required financials, and be able to be exempt from Sarbanes-Oxley for the first 5 years, which is an expensive aspect of being a public company. There were other aspects. We talked about Reg A, which we're going to explain. Private placement reforms. So the way that most crowdfunding platforms work today are the advertised private placements, the ability to now solicit, if you're a 506c platform, and actually advertise to prospective investors as opposed to having that private placement needing the pre-existing relationship. The go public shareholder thresholds are also important. The minimum shareholder minimum number of shareholders before you must go public is now raised to 2,000 with a maximum non-accredited investor base of 500, excluding crowdfunding shares and excluding employee options and other employee equity. So that's an important thing to keep in mind. And then some other aspects. So really, when you think about Regulation A, the cap was lifted from 5 to 50 million. What does that actually mean? What is Reg A? What role did it play in the old offering process? So Reg A was the small offering exemption. So when we talk about Reg A, we're talking about an exemption. These are exempt securities. They are exempt from registration. It is different from a private placement, which is what we call a Section 4 product, which is really a restricted security. So the security must be registered. There is an exemption from having to register, and now you results in restricted security. Reg A, these securities, just like commercial paper, just like bank notes, just like U.S. Treasuries, are completely exempt from the registration process. So it sounds peculiar to have an exempt security still require some sort of SEC approval, and there's a paradox here in that the greater the exemption, the more involvement the commission has to have to make sure that you're exempt. So there really isn't any winning. Throughout the various regimes of offering securities to the public, there is no way to get to a non-accredited investor without explaining who you are to the SEC and having some sort of disclosure document. That is a theme running through Regulation D, if you're doing a private placement and including non-accredited investors, if you're doing a public offering, if you're using Reg A, if you're doing public crowdfunding under Title III of the Jobs Act, whenever those rules are finalized. The common thread with all of this is that you do have to go to the SEC, explain who you are, explain what disclosure you're going to give, and they have to say, yes, that's fine, please proceed. Old Reg A allowed you to offer up to $5 million on an exempt basis. The reason it was never used is because it didn't have something called blue sky preemption. What that means is that you still had to go state to state and ask for permission to offer securities in that state, notwithstanding that the federal government gives you a pass. So that was a very cumbersome process, and if somebody could raise an unlimited amount of money from accredited investors without going to any states, without filing with the SEC. Why would I want to go through a process to raise less money from more people in a much more long-dated process? So very few people used Reg A. The Jobs Act recognized this in 2012 and increased the threshold to 50 million. And now new Regulation A has finally taken effect 3 years later on June 19th. And the SEC has come up with a two-tiered approach. And I'll explain kind of how does Reg A fit into other registered offering exemptions. Under Reg A, you now have Tier 1 and Tier 2. A Tier 1 is very similar to the old Reg A, although the threshold was raised from $5 million to $20 million. That is on a rolling 12-month basis in terms of maximum you can offer. Tier 2 allows you to go up to $50 million, including $15 million from selling shareholders secondary for the first time, officially recognized as a bona fide offering. And the question you have, the differences when you're looking at Tier 1 or Tier 2 is really, is it important for me to have state preemption? And if I want state preemption, meaning I don't want to go state to state, and the states are trying to make it easier, and they've proposed under Tier 1 to have a coordinated review process. So for the first time, all 50 states plus D.C. plus the Canadian provinces. Reg A is also applicable in Canada, which is important. And really only the first exemption that specifically addresses a cross-border offering simultaneously without going through the torturous, what we call the Reg S exercise. But you can now do a seamless offering. So these states have gotten together and said, we are going to have review on a coordinated basis. We're going to have one state review all of these offerings. It'll be on a rolling basis. And if that state clears you, then you're cleared on all the other states. And it's something called the NASA coordinated review process. So I'm not disparaging that. I think that process could work well. What are the downsides about doing Tier 2? Because you can do a smaller deal and still call it a Tier 2. The big issues with Tier 2 are, number one, you need to have audited financials. Number two, you have to keep your disclosure current. So if you've seen the public offering process where you go through and you see public companies file 10Ks, 10Qs, and 8Ks, a similar regime has been developed under Reg A, which will allow you and require you really to go through a process of updating. So instead of a S1 registration under Reg A, it's called a 1A. Instead of a 10K, you have to file a 1K. Now, you don't have quarterly reports under Reg A. Your financials are closed on a 6-month basis, but you do have to file something called a 1SA, which is your semi-annual report, and then a 1C, which is your current reports. And there are 5 events that could take place, which would require you to do a 1C plus the catch-all materiality. So compared to Reg D, it's definitely more work. The benefit of that is that you have access to the non-accredited world. The SEC estimates that about 92% of U.S. persons live in households that are not accredited. Many of these people make good incomes. They want to save for retirement. They want to have access to investment platforms. In the alternative space, if you're not an accredited investor, your real options right now are either investing in some sort of self-directed IRA product, but still you have to be an accredited investor, or if you're not accredited, Lending Club and Prosper. Those are the 2 S1 registered companies. You can go online. If you've gone on to Lending Club or Prosper, you will have your pick of loans. But the loans that are generally available on Lending Club and Prosper to investors that do not have complex algorithms to invest in loans quickly when they come out are the higher grade, higher credit loans, which is nice. But they generally offer yields of 9, 8, 7%. The loans that go the fastest and jump off the page are the ones that are either sold directly to investors, which is about 75% of the marketplace, or if they're offered on the marketplace platform, the payment-dependent note platform, then they're generally gone in less than a minute. And so multiple times a day, the loans are released to the platform. There are sophisticated investors and investment advisors out there, not to disparage them. A lot of them are clients of mine, which is great. But they have very sophisticated computers that will go through and they'll evaluate the loans that they want to be invested in, and they will beat you to the punch. It's like being on a travel website and you see the airfare to Cancun, and you say, wow, that looks really cheap, and you click the button, and it takes a few seconds, and then it says, sorry, no, this fare is no longer available, but here, the fare is now $300 more. Well, that kind of thing happens all the time in marketplace lending. And so the higher credit, the lower yield products are available to retail customers. So using Reg A Plus, a platform can actually offer this product and offer marketplace lending products to retail investors by going through an SEC review process. Public crowdfunding I have up here. Public crowdfunding is Title III of the Jobs Act. The rules were proposed, I believe, in December or November of 2013. We are coming up on the third anniversary of the deadline this holiday season with no finalized rules. Title III is one of the most frustrating things for a lot of people because really in the Jobs Act, most of the rules were hardwired into the statute. So all the SEC had to do was effectively enact what was in the statute with some modifications. The questions really are what's the threshold for having an audit and some other questions. But because of politics, frankly, because of investor protection concerns, because of other concerns people have at the SEC, the rules have not been finalized. We're hearing there may be final rules sometime later this year, but obviously there are no guarantees. And if they do finalize the rules, the threshold for public crowdfunding, you can only raise $1 million in a 12-month period. There are strict controls on how much an investor can invest, and you still have to go through an audit process and all of that stuff. So it's a very tightly wound rule, and only a few types of structures will really fit into that well. Reg D is still out there. You can now advertise on Reg D. So you've heard earlier today, some platforms advertise. Those are the 506C, and some don't. If you advertise, you have to take reasonable steps to ensure that your investor is accredited. And what that means is essentially something more than just getting a rep on a subscription agreement, but actually finding out and doing some investigation work. So we'll go through here. So here's a list of the exit report, the different reports under the two tiers. And again, these slides are up here in the back. And then I'll walk through just quickly a typical fixed income retail structure. So in a typical borrower platform, you'll have a borrower who has their loan originated from a platform lender. If it's on the consumer side, then generally there is a lending bank that actually has the loan and makes the official credit decision. The loan is then sold back to the platform lender, and the lender holds the loan and then services the loan for the life of the loan. So if you're a Prosper or Lending Club customer, all you really get in touch with is Prosper. They service the loan. They send you statements. They are your single point of contact. You're with them for the life of the loan. What do they do with the loan? Well, that's when the dotted line comes in. There are a couple of things that happen. One, they sell the investors. So what I call side investors. Platforms will have agreements with specific investors to sell a certain amount of loan product, or an investor will have a right of first refusal to buy a certain amount of loans. The second thing they could do is form a fund. So for the retail customer that doesn't want to be on their computer every day and pick which loans it wants, and generally you see this in the consumer world where people are less fussed about what loan they're in and they're really managing to a specific yield, then the fund product and the discretionary fund product is really, and you're seeing that with the fund. And then with the closed-end fund, which is also an SEC-registered vehicle, you will have the ability as a retail investor, not just accrediteds, to invest in a product that invests in these loans. It'll be managed by an asset management firm that will have the ability to source this product from the various platforms. And all you really care about is that you get the right yield. The other interesting thing about funds is that they're listed, so you could actually have, because of the potential scarcity value of these fund assets, you could have the fund trading at a price that is higher than its actual NAV, which happens sometimes in the BDC world for about half the funds. But in this world, if there's a scarcity of product, then you generally will see trading above NAV. And then finally, for the products where an investor really wants to go online, they want to pick and choose which loans they want to stay away from the ones they don't want. You see this in real estate. You see this in small business. You will see a migration towards a payment-dependent note product issued by a special purpose vehicle. So the loan will be held by the lender, or it'll be sold to the special purpose vehicle, and then that vehicle will become an issuer of notes that pay based on whether the borrower of the underlying loan pays. Now here you have two risks. You have a risk that the borrower doesn't pay, and you have a risk that the borrower does pay, but that the money somehow doesn't make it to your account, or it doesn't get allocated correctly, or something gets screwed up in the process. You also have custody issues. You have issues with respect to are my payments actually being held in a secure account? When do I have access to my funds, and the like? And then is there secondary liquidity? And those are all issues the industry is really dealing with, because right now there is no liquidity. It's really a buy and lend and hold type market. So through Reg A, both the fund market and the SPV market, I believe, is going to open up widely for non-accredited retail investors. And I think that will broaden the number of choices somebody has. Somebody wants to get into a Street Shares 20% loan, if somebody wants to get into a Bond Street loan, or other loans through marketplaces like Patch of Land that offer higher yields than you can get today on Lending Club or Prosper using an ordinary computer, then this is something that I think will have a lot of traction. And I'll stop for questions. Okay, I'll be around. Question, yes. Yeah, so institutional investors generally face the market either directly through direct purchase agreements or through secured financing. So you'll have a lot of institutions who are trying to get into these same Lending Club Prosper loans. And as much as they're originating, there is still a supply shortage in this marketplace. The institutions are reaching out to the platforms and trying to secure loan purchase agreement, loans purchase arrangements, or they'll do some sort of secured financing, which will be backed on an as-needed basis as loans get originated. So the institutions are definitely in this market. Many of them are forming their own discretionary funds, and then looking also at the closed-end product if they want to offer a retail product. Closed-end funds have had less favor thus far, and a lot of U.S. Issuers have gone to the U.K., like you saw in the Ranger deal, because the regulatory environment, believe it or not, for a registered product here is a long-dated and expensive product, and the lawyers and accountants charge a lot for this type of service. And so what you're seeing, though, is institutions are also looking at these products, and they want to get as many of these loans as possible. And they also are looking for algorithmic tools that will enable them to tell the difference between two loans that on their face would look alike. And they need to make that decision in less than a millisecond, and they need to be able to execute. So once they decide to buy the loan, that they actually get it. And so Orchard and Eaglewood are sort of what I call the two gateway firms out there that are helping institutions be more efficient in working with these marketplaces.